Welcome back. It's Maddie, the Mortgage Ricky Roma, here with another chapter of Mortgage A to Z, because A is for always, B, B, C, closing costs, gotcha. Buying real estate's expensive, so I wanted to provide some input on closing costs relative to the buyer side. Don't worry, there's closing costs too when you sell, but this channel deals with the front end. So the cost we're going to focus in on have to do with the buyer's side and a breakdown of that form known as the closing disclosure. The closing disclosure, aka the CD, it's relatively new, but I think it's been in practice for at least 8 years now. If you haven't bought anything in 10 years' time, it replaced the good old faith estimate form, which in my opinion was easier, less of a headache, and static from start to end. Now we have a loan estimate and closing disclosure that replaced the good faith estimate. So leave it to your government to take something simple and make it more complicated. Now the benefit was to help lenders play by the same rules, establish some conformity, and hold the lender accountable if there are significant changes start to end. I like to think of the loan estimate as the first draft and the closing disclosure as the final draft. Today we're going to focus entirely on the CD, the final form. Last week we spoke on the relative cost to buy a home to the sales price, so it's important to get a grip on what closing costs to expect based on the state you're buying in. Now behind me is a sample closing disclosure. It breaks down nicely into two sections. One, the loan cost, and two, the other cost. And I like to think of section one as your hard cost. Now these fees are usually fixed or limited, but they can be manipulated along the way based on the home price, or maybe if there's any changes to your loan program, the occupancy, or if you decide to buy down the rate. Now the very first letter under loan cost, A, this is for all the lender-related fees. In this section, it identifies points, also known as discount or origination fees, tied to the rate selected. But it also includes application fees, processing fees, underwriting fees, and maybe perhaps a commitment fee if you're in the state of New Jersey. What I appreciate about the form is that it exactly highlights what it costs to do business with said lender. Expect different costs from different lenders for processing, origination, and points. And in some cases, it helps to ask each lender, hey, what's your best rate with the least amount of costs, or just the base fees? Now, section D lists all the costs that are third-party related that you didn't shop for. Now, these fees are required for most loans, like an appraisal, a flood certificate, a credit report, and tax service fee. Now, they're all one-time expenses that you're either required to pay in advance or at closing. Sometimes a lender will take an application fee to prepay some of these fees. Now, these fees can differ some, but are usually linked to the lender and the vendors associated with that lender for, let's just say, credit report and appraisal. Now, section C will deal mostly with your title fees and your escrow fees. Now, title costs are usually state regulated, and it'll be similar title company to title company, but now the onus is on you to shop for them, and you can likely select your title company, pest inspection company, survey company, and I'm sure there's a range for these fees. Now, let's work on the bottom half of the form, which I refer to as the soft cost or the other cost. Now, each state and local county will have some government fees, which they can range from transfer taxes based on the home price to the minimum of recording your deed and mortgage. And you can't opt out of these fees because they're required, and the title company will disperse and keep records. The next section, F, has to do with your property taxes, your insurance, and your interest. If you're getting a loan, you'll be required to set up homeowners insurance and pay that annual premium in advance for the first year. Now, property taxes will be paid in arrears or advance based on the municipality requirements. Some states, may have you pay the school taxes in advance. And last, when getting your loan, you're going to have to pay interest. Think of it as the equivalent of your prepaid rent for the partial month that you're going to move in. Now, the funny thing with a mortgage is that the first payment is usually 30 days, a month or so, 45 days after closing, because your mortgage payment is built on arrears. So if you get the bill, understand that it's the interest for the month before. In example, let's just say you close February 15th and you're going to prepay for those 2 remaining weeks of the current month. But when you receive your first bill, not in March, but in April, it's going to cover the interest from the period of March. Now, not to double dip, but Section G involves any escrow, or sometimes referred to as impounds. And this is an account set up for you at closing to collect a few months of the taxes and insurance to pay for those due dates in the future. Remember, you're not paying your mortgage for at least another month after settlement. So the lender is going to need some money to set up that account for you to pay these bills when they're due and by the max discount period. Now, don't worry, lenders can't hold an obsequious amount of capital in these escrow accounts. It's going to be a 2-month cushion, and they're required to evaluate them at least once during the year. And sometimes you're going to discover that your tax bill's gone up, and as a result, your payment will increase, or you're going to have to pay some money into the escrow account to offset any payment difference. Now, there are some odd years. I will have you keep in mind that if the property taxes go down or the insurance costs go down, that you may get a refund or a disbursement from your escrow account, but more than likely, they're going to increase year over year. Section H, the other cost, usually related to such things as homeowners association fees, maybe a home inspection or home warranty. Now, sometimes these fees can be split or paid by the seller, but usually they're going to be paid by you, the buyer. When you sell, you may have that pleasure to offload these fees to the next man up, but then only realize you're the one paying for the buyers and sellers agents. Now, each HOA has their own rules and requirements. Sometimes you'll have to pay a few months to contribute to the capital contributions, or it just might be a large flat fee. So these are important fees to inquire ahead. Now, it's important to notice that on this form, who's paying them? The standard would be that the buyer pays all fees related to the transaction, but the seller could pay them, or you could, as it shows, have another party pay for them, maybe like a realtor. It's not uncommon to make an offer in which the seller credits you a flat dollar amount at settlement, or agrees to pay maybe one origination point, or whatever you can negotiate out of the deal. The beauty of the business is that there's always a multitude of ways to make a deal work, including the closing cost. So understand the format, and use this information to help you identify the right loan for you at the right cost, and perhaps help you negotiate the very best deal. Got it? Now, Williamson, I'm talking to you.
You just cost me $6,000. $6,000 and one Cadillac. That's right.